Sachs.
Hi, everyone. Thank you so much for giving me your time. I just want to start with this disclaimer that all signals and trading opportunities provided, both oral, written, or electronically, that are disclosed to visitors or subscribers are for educational and demonstration purposes only. Right Line Trading takes no responsibility for any participation by visitors or subscribers within the futures or forex or stock markets, nor for any profits or losses may be incurred. Everyone should know that trading these markets involves substantial risk, and it should be understood that a person can lose a substantial amount of money. Therefore, the participation in these markets is not appropriate for everyone. Do your own due diligence, consult a financial advisor prior to making any trade decisions. And those of us here at Right Line Trading, we are not registered financial advisors and not licensed commodity trading advisors. So with that said, I want to start the talk about oscillators. Now, oscillators are really indicators that I think are the most misunderstood indicators out there. If you look on YouTube, you try to Google information, there's very little information that teach you how to, that explain really clearly and concisely how to use them. And in fact, I'm going to show you over the course of the time, over the course of time, the way that oscillators need to be traded has changed significantly. Now, the first oscillator was created by George Lane, and what he did was he created stochastic. And George Lane was really a brilliant mathematician. And what he did was he used the oscillator only to trade divergence. He did not use it to assess the direction of momentum on a trend trade. He was looking to call tops and bottoms. Now, he did this in the market in 1957, when I believe the ability to call a top and a bottom was probably appropriate. In this market, things have changed. Now, I just want to I want to explain a little bit about what momentum is. Momentum is a second order derivation. And what it is doing is it is looking at the rate of change of speed. So, to give you an analogy, if you have a car that's going around a racetrack at 100 miles an hour and constant speed, its momentum is flat. It's unchanging. But if the car begins to accelerate from 100 to 300 to 500 to 700 miles an hour, obviously its momentum is increasing. If it begins to decelerate, its momentum is decreasing. So the rate of change in speed is a second order derivation, and George Lane believed that this second order calculation or momentum led price. And back then, he used it to call tops and bottoms. And I believe that he was probably quite successful, even though as reading his biography, he did die broke. I don't know what that says about his ability as a trader, but he was a really brilliant mathematician. Now, I just want to show you really quickly what the stochastic oscillator is doing when it creates its percent K. It's important for you to understand, if you use an indicator, what it's doing. That's looking at the most recent closing price, and it's comparing it to two moving averages. The L14, which is the average low of the previous 14 candles or trading sessions, or the H14, which is the average price of the previous 14 candles or trading sessions. So that as the close of a candle approaches the high, the average high, or the close of a candle approaches that average low, momentum is increasing, and that percent K line is going to start moving to the downside or start moving to the upside. And that's just what we're looking at. Now, back in the day when George Lane was trading, I believe that divergence probably was a really good signal. And what it's telling us is really this. When price moves from here up to here, it accelerates up to this point with this much momentum. Then it falls. And when it accelerates up to this price point, it accelerates with less momentum. So the rate and change of speed in price as it accelerates up to that second top is less than the previous top. Now, if you'll notice, it tried to make a third top, and it did it on equal momentum. So it also accelerated up with equal speed as the previous, but it didn't have as much momentum as the first move, and that really was the harbinger of a price crash. And this is how he traded it. Divergent signals, I believe back in the 50s and 60s, and probably the 70s and 80s, were quite accurate. I also wanted to give you another example. Price is accelerating up to this point on so much momentum. This is just stochastic. Then it accelerates up to this price, a higher price, but if it makes a higher high, it needs to make it and accelerate up to that high with greater momentum. It doesn't. It has equal momentum. And you see that also foretold or foreshadowed a collapse in price. Now, if only the market was this easy today, and the markets have changed dramatically. Now, I don't want to talk about this divergence failure because you know it fails very commonly. Now, also, you could use an oscillator like stochastic to track a high or low. Here you have the cross of the percent K line across the 80 line down, gave you a short trade. This was a cross of the percent K line above the 20 line for a long trade, above the 20 line for a long trade, right here above the 20 line for a long trade. Here this trade failed. Then we cross the 80 line for a down. We cross above the 20 line for a long. And you see the tracking of price with stochastic was very accurate. But now we know that the market has changed in complexion. And what we do is we have to trade the problems that we have in hand right now. I mean, we want to have tremendous predictive power in determining not where price is gone, but where price is going to go. And we can't just make an overall assessment. We need to create an exact entry. And our trading rules, though, have to comport with what is going on in the market today. Now, I believe, and it's my personal belief strongly, that it is no longer mathematically possible to call a high or a low, because everybody knows that the market can stay overbought for weeks or months before it turns. And if you try to fade the market on a divergent signal, you're going to get beaten up. It doesn't make any difference whether it's divergence in an overbought zone or divergence in an oversold zone. The market is going to continue to rise. And why is that so? The reason is because right now, the majority of stocks, the majority of futures markets, and the majority of Forex markets are driven by institutional money. Our goal now is not to try to tell when institutional money is going to step aside, but to trade in the direction of institutional money. And they can take the S&P and continue to push it higher, where the stochastic or any oscillator provides you with an overbought signal, again, for weeks or months. So, in an era of institutional volume, how are you going to get precise entries? And the first thing is you have to develop a trading methodology that's effective. So you have to dispel the fallacy that you can call a top or call a bottom, because you just can't. As long as institutional money is still driving price long, it'll run over pivots, it'll run over resistance to the upside, it'll run over everything. Institutional money will drive price higher. Now, markets will reverse at the whim of institutional money. Now, mathematics, even though we can't mathematically call a high or a low anymore, and if anyone tells you they can, I challenge that. Because institutional money calls the tops and the bottoms, not any kind of mathematical assessment. And to take it one step further, if you look at any market as a closed system that has an intrinsic waveform or an intrinsic pattern, like an Elliott wave pattern or a Gann theory pattern, institutional money destroys it. And that's why Gann theory and Elliott wave theory simply don't work. And if you try to look for that 5-wave pattern, and institutional money steps in with a machine or computer generated trade, it's going to run that intrinsic harmonic movement of the market and destroy it. And to take it even further, Japanese candlestick patterns are very, very important, and I like to trade them. But 400 years ago, when the Japanese rice traders invented them, they were invented and predicated upon a basic premise. And that premise was that the power of each buyer was essentially equal to the power of each seller. There was no institutional money. So everybody out there was nothing more than a small commercial trader. And that was probably the case back in 1957 when George Lean was using the oscillator to trade divergent signals. This doesn't work anymore, nor does any intrinsic waveform or pattern or any software that's going to tell you it's reached a top or a bottom. In fact, you're going to see how we leverage traders caught in the wrong direction and we run them over. I mean, that's part and parcel of our methodology. Now, what still applies and will always apply is that price wants to revert to the mean. Now, the further that institutional money takes it off the mean, the more power it will snap back to the mean once they step away. So if you're if you have a 50 period moving average or a 50 exponential or a 100 simple or 100 exponential, whatever you use as your mean price generator, price is always going to have that drive to pull back to the mean. And once institutional money steps away, it will snap back. The only problem is we just can't tell when they're going to step aside. And all these counter trend traders they're salivating for that snap, but they get run over and over again. So we can only take trades in the trend in this era. Trading divergence is tantamount to trading against money flow, which is institutional money. You can only trade in the direction of institutional money. And the only indicators that are going to help you are those that help you track the flow of institutional money, because that's the whole ball game right now. Now, what indicator most accurately assesses buying and selling pressure, completely ignoring any potential divergence signal? Because this is what we're going to use. Because if it does, then what we are essentially doing is we're following the footprint of big money. Now, I'm going to compare the Laguerre oscillator with stochastic relative strength, Williams percent K. Really what a lot of traders use to either trend trade or for divergence signals, and we'll see how it's completely different and how much better it is. Now, the Laguerre is a much more complexly coded oscillator. It comes with a default gamma of 0.5, which we've modified. And it comes with multiple filters, which we've also modified. And that controls the speed and stability of the percent K line. And the percent K line on our Laguerre is really quite astounding. Now, another principle that we use, before I even talk or explain this slide, is that we never do an assessment based on any indicator that does its analysis based on our trading time frame. We always do what's called a triple screen assessment. So all of our indicators are not only looking at price on our trading chart, but they're looking at our two higher time frames. I first came across this methodology back in 1999. I read a book by Alexander Elder. It's the first time I ever heard of what was called the triple screen. And that's how he traded. And I've been in touch with him for many, many, many years. He's a brilliant guy. He's really elderly right now. I don't know if he's still actively trading. And I haven't been in touch with him for a while. But he really pioneered the principle of you must use multi-time frame assessments with your indicators if they're going to tell you the direction that price is going to move out into the future. So our Laguerre has two components to it. The upper line here is the multi-time frame assessment of momentum. The lower line is the momentum that's assessed off your trading chart. Now you'll see, I wanted to create a couple of slides to show you what happens to price when there's no multi-time frame alignment of momentum. That's this whole left side here. Price just chops. And to try to trade or take a trade in here, this is a 3-minute. It doesn't make any difference what the instrument is. This is time frame independent, instrument independent, market independent. Momentum is a universal force that drives price and provides us with the ability to tell where it's going to move on the right edge of the chart. It's all that matters to us. So I purposely took out the instrument. All that matters is the time frame, and it is time frame independent. Once the long-term or multi-time frame Laguerre goes green, we know that all our higher time frames are locked long. They're locked above the 80 line. And that momentum on our higher time frames is predicting that price is going to rise. All we need is a signal from our trading chart. We get it right here. This is a candle that prints intra-candle. You're going to see it flicker, and it's also alerted. So you get an audible beep at the close of the candle. You're going to take this trade long as the long-term Laguerre or that triple screen assessment is green. As you can see, the price just goes up, 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 and up. And you can exit on the down candle, which is the cross of our trading chart Laguerre below the 80 line, for a nice trade, and you have an exact entry. And I wanted to show it again. It's still a 3-minute, but you can see what happens when there's no multi-time frame alignment of momentum. What happens on your trading chart's irrelevant. And if you try to trade momentum off of it alone, it's not going to work. You have to wait for the multi-time frame assessment to go either green or red. And then when you get a long signal, when momentum on your trading chart crosses above the 20 line, the candle flashes and gives you a beep, and you're above the 50 and above the 15, which are these two moving averages. They're both exponential. In fact, they're special. This is a 50 exponential of a 50 exponential. This is a 15 exponential of a 15 exponential. They have the speed of an exponential, but they're more stable than an exponential. You're in long, and you capture this great move up. So you don't get order from disorder until money flow aligns momentum to the upside in a triple screen assessment. If you try to trade any other time, you're going to get into big trouble and get caught up in chop. Now there's two configurable trades that we take with the multi-time frame Laguerre. The first is that first crossover of I kind of wiped it out here, of the trading chart Laguerre across the 80 line to give us this arrow short. That's a number one trade. Then if we get a pullback and continuation with both Laguerres, the multi-time frame and the chart Laguerre, locked down, we take the continuation. That's a number two trade. And the entries are precise. 1 tick below, or 1 pip below, or 1 cent below our entry candle. And we're going to write it down. And why is this trade so successful? I mean, 85% or more of your trades are going to work. I'm going to show you how I've traded in the live trading room off the right edge so far this week. I really have not taken a single losing trade because we have so much predictive power in trading in the direction of multi-time frame momentum. And here's another trade. It's a number one. You can see the Laguerre on our trading chart dropping below the 80 line. You can see the arrow, which is going to flash intra-candle and then print into a long-term Laguerre that's already red. Our longer-term time frames are already pushing price down. Momentum is moving to the downside, and it's accelerating to the downside. That's why we've got this red line, because it's assessing the higher time frames. And down we go on price on our trading chart. Doesn't matter what your overall trading methodology is. This is going to always keep you in the right direction or the direction of institutional money. Now we only trade short below the 50 and long above the 50. We want the 15 to be red and sloping down, the 15 to be red obviously and sloping down on a short, the 50 to be green and sloping up, and the 15 to be green and sloping up for a long. Here's a long trade. It's a number two. It's a move up, pull back on the wick, dual Laguerres locked long. That means the multi-time frames above the 80 on our two higher time frames. Our chart Laguerre, look at it. It's stuck at the 100 line. Only institutional money can plaster it up there like that and keep it there like that. And you're going to go long. And that's a very low risk, high reward trade. Now, back in the old days, on a stochastic, you'd be looking for divergence. But we know that doesn't work anymore. We're looking to trade in the direction of the trend in which buying pressure is so strong, it just plasters a multi-time frame assessment of momentum up against the 100 line on 2 higher time frames and our trading chart. Nothing can do that but institutional money. And here's a 30-minute. There's your entry. The rise in the Laguerre line above the 20 line on our trading chart into a longer term time frame that's green. Now it's not quite green here yet. You can see it's a little bit yellow. So you don't have an entry here. You'd have to wait for a pullback. But you can see how as long as that long-term time frame stays green, price is going to press to the upside. This really is not an entry. We don't get into a trade, you don't get into a trade long that's below the 50. I just wanted to use it as an example to show you how price is going to press up, and that momentum is really a leading indicator as long as it's a multi-time frame assessment. We're looking at the 30-minute, we're looking at the 30, 60, 90-minute, and we're looking at the 270-minute to create this multi-time frame assessment. Here's the 3-minute again. There's the drop below the 80 line, the arrow, and you can see the multi-time frame assessment is short, and we're going to take this market down. Doesn't drop right away, but as long as this multi-time frame line stays red, there's no way you're going to exit this trade. And look at the chart like here. It is almost always plastered to the 0 line. That's significant selling pressure. Here's a great short trade. The 60-minute is a great time frame. Doesn't matter whether you're trading futures, forex, or stocks. It really gives you good signals. And there's your entry. The drop below the 80 line on the chart into the multi-time frame direction. And boom. Now you still have it pressing short, but this arrow takes you out. The Laguerre on your trading chart comes up above the 20 line, and you're out of the trade. Here's a 3-minute again. Oh, here's where I wanted to show you the difference between our Laguerre and the second line, that which is here. This line is stochastic, and the bottom is relative strength. Now, our indicator is configured to track the direction of institutional money, not fade the market on a divergent signal. If we did that, we would have a really big problem. So there's our entry on our Laguerre. You can see it drops right here below the 80 line, and here's our entry. Our Laguerre long term is locked short all the way through. Price gets pushed to the downside. You're out on the up arrow when the Laguerre finally pops above the 20 line. And then you don't have another re-entry signal. But look what happens to stochastic. The stochastic line pops above the 20 line fast and takes you right out of the trade. It's not looking to trade the trend, it's looking and sniffing around for divergence, which we don't care about. So the stochastic isn't going to get you into the trade, and and if you try to take this any kind of signal, it's going to pop you right out. Relative strength is going to give you no trade at all. So you can see the major difference between all the indicators and the way they assess the movement of price. They're all looking at momentum. When the formula's changed and a multi-time frame assessment is done, that's what makes all the difference. And in my 15 years of trading, I wouldn't give a nickel for an indicator that only uses price on your trading chart to perform its analysis. It doesn't have any predictive value as to the way that price is going to move out into the future. it's got to do a multi-time frame analysis, or else you're not going to be able to predict on that right edge where price is going to go. Now, this is in 2 days of trading in the live trading room. I took 11 trades. I have 10 winners and 1 loser. And the 1 loser cost me $40. And it really wasn't a loser. It was a trade I muffed, to tell you the truth. It was a winner that I mismanaged. We're only trading 2 contracts. It's not a lot of contracts. And we're trading crude oil and we're trading the NASDAQ. But what we're trading and what time frame we're trading is irrelevant. If you could trade, and this is live trading from 5.6 to 5.7. We're up $860, and I think we will easily eclipse 1,500 after commissions for the week. And this is the kind of money that almost all the traders in our trading room make, that you're going to be in if you come aboard with this indicator. And it's going to let you trade with this kind of precision. And to get 10 winners and a scratch loser and trade at 90% winners, even for 2 days, is pretty tough to do. And I just want to emphasize one more thing. The newbies in the room, I always ask them, what's the most important thing to do when you day trade or swing trade? And I'll give them a whole bunch of potential choices. And most of them will always say to get winners. But that is not your most important goal. Your most important goal is to avoid losers. If you can trade and not take losers, you can make an enormous amount of money. Now, $860 is a modest figure. And if I wanted to trade more than 2 contracts, I could trade 4 or 6. But I keep the number small because I want everybody in the room to be able to keep up. And a lot of traders in the room have a small account. If you have a $5,000 account and you can make $1,000 a week, you're making 20% per week. So that's an incredible return on investment. That's what we do, always trading in the direction of the multi-time frame assessment of momentum when our chart Laguerre moves into that long-term direction on a long above the 50 and on a short below the 50. So I'll go to my offer and then I'll see if you have any questions. So the multi-time frame Laguerre indicator, I'm telling you, it works just as good on stocks, futures, or Forex. Momentum, as you know, is a universal force that moves price on any market. And it does not matter what time frame you use, obviously. Momentum is present and powerful on any time frame, from a 1 minute to a 3 hour. I mean, I have traders trading daily bars. It doesn't make any difference. Now, normally the indicator is $5.99. Because of this webinar, you're going to get that $5.99 price, but you just put in the discount code 50 off or 50 off, and it's going to drop to $2.99, which is a 50% discount. It comes with a lifetime license. If we make it better, we're going to give you the upgrade for free. And we're always looking to make it better, believe me. And the first 10 orders are going to get 1 month in the trading room with me. If you were in the trading room with me, you'd be up almost $900, and you could have paid for this indicator 3 times over already in 2 trading days. So the offer expires on May 11th, which is Saturday night at midnight. Let me see if I have any questions. I hope you'll come aboard, and I hope to see you in the live trading room, because I'm in there to be successful. And I take it to heart, and I look upon everybody in that room as my family. I've had traders in there for almost 5 straight years. We have 150 traders in our live room, and we trade with really amazing precision. If I had my tech guy here, I was going to edit the trading day and show you how great we've done in the last 2 weeks on video. I just don't have them here. But you saw the back end, and believe me, that back end is accurate. So let me just go to see if I have any questions. Okay. Let me roll it over here. I do have some. Let's see, I'm at 5 o'clock. Okay. Hey guys, good afternoon. Okay, great. TJ Pac-Man, I think the new micro E-minis are great. I just have to see what kind of volume they're trading on. I mean, remember when they came out with stock futures and everybody, raised the roof on them, how great it would be to trade a future on Google rather than have to buy Google or trade an option on Google. Stock futures never developed any significant volume. So if the E-mini micros or the new micro E-minis develop good volume, they'll be great to trade. You're going to risk less to make less, and there's nothing wrong with that. TJ, I think volatility is important, but I'll tell you, we just trade what we see. As long as we get a multi-time frame alignment, here's the way I have to look at it. I only have 2 minutes. A multi-time frame alignment of the Laguerre is never, and here's the thing you want to prevent. If an indicator is assessing data from your trading chart, and you get a signal, it could just be an accident. It could be, when I mean an accident, it could just be a random event that happens simply because there's price movement, but it's not a valid entry and get blown out. A multi-time frame signal is almost never simply a random chance event. You don't get a multi-time frame alignment in anything unless something's at work to create a powerful movement in price in one direction or another. In this particular case, it's institutional money. If the VIX is high, we're going to get great movement, and hopefully we can leverage each swing and get in a nice trade. The TOS, it works on Thinkorswim. It's not free, but you get it for the same price. And it is really a good indicator on Thinkorswim. Thank you, Jacqueline. 30-minute bars, you can trade easy. I put up some slides with 30-minute bars. Personally, I really like 30-minute bars. Thank you so much, Banyu. I appreciate that. TJ, I don't like footprint charts, but that's just that's just me. I use other metrics as volume metrics other than footprint charts. Remember, footprint charts are usually just taken off your trading chart or multiple single daily assessments. I don't like any assessment that comes off of 1 day's worth of data. I'm a profound multi-time frame assessment guy. If the footprint did an analysis of a week's worth of data, I would give it a lot more credence. The brick size can be anything, George. It's a 15 EMA, 15 and 50 EMA. I only have 30 more seconds. Listen, Banyu, the number of trades you get is determined by the speed. If you trade a short term, you're going to get a lot of entries. A long term, you're going to get fewer. We're going to configure your ATM strategy. If I have a long term, you're going to look for a big move. If it's a short term, you're going to look for a smaller move, and you get more entries. The trading room is $149 a month as a standalone. We don't, because we're just building the new website, David. If you send us an email at info@rightlinetrading.com, we'll send you a link. It's $149. You get that for free with the indicator. And let me finish up really sorry. Everything that you saw is included, Robert. I'll talk to you about the pivot indicator, but it's not included. It can be used on Ninja 7 and Ninja 8, both. Both platforms, 7, 8, Thinkorswim. Nash, I don't even want to get into options, but if you know the direction that price is moving, you're going to be in really, really good shape. My market outlook right now, TJ, is down. I mean, the market's rolling over based on fundamental analysis, uncertainty. And uncertainty, I think, is going to take it down. I got to go. I really don't want to run over. Everyone's been very kind to me here. Hope you'll come aboard. And thank you so much for having me and letting me have these extra couple of minutes. I wish I could spend more time, but I really want to be respectful. Everyone have a wonderful, wonderful evening. I hope to see you in the trading room tomorrow. Take care and have a great, great evening. We're at info@rightlinetrading.com. Take care, everyone.
All right, we want to thank Mark for joining us today. And again, the link is right there in the chat, and it'll go out with the recordings. We're going to try to stay on time here. We're going to set up our next speaker.